Welcome to the Tradiers, the Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. You know what I was about to say, right? The Tradier rundown. So don't get old, people. You get confused very, very easily. Anyway, I'm Jim Iuorio. That's Bob Iaccino. We are also 2/3 of the team at unfilteredinvestor.com. I know a lot of you guys have checked us out over there. We really appreciate it. But this is Tradiers, the Trader's Edge. Bobby, this is an enormous day. Okay, I made the argument yesterday is that whatever you think of Google and where they are in the pecking order of the Mag 7, the fact that they're coming first here makes it one of the most important ones. Do you concur?
Yeah, I agree. I mean, you've only got a handful of trillion plus market cap companies, and they drive, especially obviously the Nasdaq, but more and more the S&P as well. You know what I'm interested in talking about a little bit today, though? You see the 2 years up 18 basis points.
Yeah. What is up with that? I cannot figure it out at all. And I'm looking at the 10 years doing the same thing.
Oh, we got somebody who might be able to help us with that.
Yeah, I think so too. And you know what? Let's because I always say to you guys who watch us that you may think Bobby and I are full of crap. We've been listening to ourselves talk on air for 25 years each. Sometimes we think we're full of crap, but the one thing we cannot deny is that we get excellent guests to say yes. We have our old and dear friend, Mr. Jeff Kilberg, the CEO and CIO of KKM Financial. So Bobby was just reading me an email from 3 years ago, inviting you on the show and you giving a song and dance why you'll get back to us. Might it be the right time? An actual email, hard evidence. So all your accusations of we've never asked you on, you're full of crap. What do you have to say to that, Kilberg?
I was waiting for you to buy me a drink at your restaurant, Jimmy. Every time I go in there, you say free drinks on me, killer, no problem. However, the ice cubes are $7 a piece, so that's what the slow.
Those are good ice cubes. Those are good ice cubes. Yes.
No, great to see you. Great to see you, Bob. It's been a long time, boys. We go way back. And for clarity, for all the viewers out there, Jimmy said an old friend. Jimmy's much older than Bob and myself, like light years. I think he graduated high school in like the 60s. So I just wanted to set that for the record.
Well, it's like a fucking vaudeville routine when you two get together.
But there's one quick story, which, by the way, the earnings might be out. Both are down 2%, 2.5%.
Jimmy, real quick, for you guys watching the show, I can't look at the earnings like I normally do. Put them in the comments and we'll throw them up on the screen. If you see anything specific, Remo, Widge, whoever's out there that normally watches, put the earnings up if you see them.
Thank you guys for doing that. Yeah, so Tesla's down $11, 3%, and Google's down 1-ish. So I will be keeping an eye on that too. But one more quick funny thing before we start real live market talk. And this is probably about 15, 20 years ago. And you and I were doing a show somewhere. And for some reason, it was around when was it the Belmont or the Preakness when Secretariat, was that the great race was the Belmont, right? But anyway,
we watched it live.
We're talking about it. And I start talking about watching it. And you go, you mean in the movie, right? And I go, no, I watched it live. And then you go, how old are you? That was one of the first conversations we ever had.
But you do look good. You don't age, Jimmy. So you're like a fine wine, my man.
Because I'm the devil. Okay, let's get moving right along. Okay, so I want to go real in depth because I am so interested in the Essential 40 ETF that you launched. I want to hear the nuts and bolts of it. And I know why I think it is an amazing product, but I want to hear your sales pitch of it, and then we'll look at it.
No, well, thanks, Jimmy. It's been a passion project of mine. We launched in 2014, and I really wanted to find a better, more modern version of the Dow Jones. And we created these 40 stock portfolios. These are 40 stocks that we deem critical to the U.S. economy, the American way of life. If you remember Peter Lynch back in the 80s, I know you do. He was a legendary investor. He was buy what you know. The Essential 40, which is an ETF format, ticker ESN, it is literally Peter Lynch 2.0. This is a buy what you need and buy what you use. So we look at this portfolio. These are all names that you know near and dear to the heart. You don't hear a lot about some of these names, but some of these names, like a FedEx or United Healthcare, has come back from life. You know, a Masco, an EPD, a Chubb. Of course, we have the Mag 7 names. We have 8 of the top 10 S&P 500 names. But why we're different, why we think we built the better mousetrap is that we equal weight the portfolio. Therefore, in times of distress, we have the ability to mitigate risk. So that's it, kind of an elevator pitch, but it really has done well. It didn't go negative once in 2026 on a 5-year perspective, Jimmy. We're in the top 19th percentile. This is really a portfolio that I have the vast majority of my net worth in it. So I really look for the long-term capital appreciation. But these are stocks that everyone knows. They're blue chip names, and you may own 20 or 25 of them, but we own all 40. By owning all 40, that's kind of the secret sauce.
Looking at Google earnings, according to Remo, $9.11. Does that seem right?
Google is down $6 right now. I got Tesla's down 14. IBM, everything was red, by the way, going in earnings. Remarkable to see.
Yeah.
Someone had the information. Was Beeks get the information before him? Because everything was red just going into the close. It's kind of a weird day in trading as we're all kind of waiting for Google to set the tone. But
yeah, there's going to be a lot of old movie references and old guy references in this particular show. By the way, if any of you watch this and you haven't seen Trading Places, you should probably stop watching us
tonight.
That's my
watch
point.
Trading Places tonight, people. Yeah.
Yeah. So one of the things that I liked about the Essential 40, Jeff, was I lined it up with the NASDAQ. When you said yes on the show, I wanted to go back and look at it. You outperform the S&P more often than not, and you underperform the NASDAQ to the downside. Yes. Which I find to be extremely valuable. So who do you think, other than everyone, is the right demo for this kind of a product?
Well, if you look at RSP, that's the Invesco product that 70 or 80 billion in it. That's the equal weighted S&P 500 index ETF. And that's kind of an apples to apples comparison. Fortunately, Bob, we've had a superior Sharpe ratio for the last 12 years. We've had better performance year to date, 1 year, 3 year, 5 year. It's just a different construction, and I think we're actively managed. So we look at this portfolio, we speak on a daily basis, we meet committee-wise as formally on a monthly basis, but we don't rebalance the portfolio until every year. So we wait till the second Monday of every January, kind of the antithesis of us trading in the pits back in the day versus trading every minute. The reason is that you have to let your winners win, but more importantly, you have to let your losers lose. And that's how the old adage that you just kind of brought up about how to make more money by losing less. If you think about all the distress, all these volatilities, acute volatility, we see the VIX go 30, 40, 50, even 60. What happens? People sell what they know, what they like, right? They sell some of the hot names, but they tend to hoard the Lockheed Martins, the Waste Managements, the 3M, the Chubbs. These blue chip boring names get hoarded in times of distress, and that's why we have the ability to perform better to the downside. In 2022, when you saw interest rates moving, we can talk about interest rates in here in a little bit, Jimmy. Highest close of the year, I think, for the 10-year. But what's interesting is when you see interest rates moving up in 2022, and I'm not going to pull a rotator cuff, patting ourselves on the back, but we were only down 10%. The S&P 500 was down 20%, and the NASDAQ 100 was down 35%. So those types of drawdowns, that's really important as you're trying to perform longer term for your capital.
So you just mentioned the 10-year. We're 4.65-ish probably, right?
Yep.
Okay, I'm perplexed by it. There'll be some that argue that, well, the economy's doing pretty good. People aren't buying bonds, they're buying other shit. Maybe that's part of it. But I actually think there's a very aggressive worry that we are spending too much damn money, and that the longer this conflict goes on, it adds to a pool of bonds that was already too large that needs to be sold. Do you think that there's any sort of sinister worry in the 10 years yield?
It's a bit of a 1-2 punch. I agree with you there. And yes, that's a rare occasion. I'm agreeing with Jimmy here. But the 1-2 punch is that, I think the appetite for U.S. Treasuries while this is going on maybe has diminished. So it's a really interesting moment in time. It seems like every time we've seen 465, 470-ish, there's been some type of, not intervention, that's the wrong word, but there's been some type of articulation, some commentary either out of Bessent or the Federal Reserve. And we'll see what Kevin Warsh does here, but we're not raising rates. We're not. So are we going to endure higher rates? And I think that's kind of a drag because it feels like this earnings season, which is expected year-over-year growth, is gangbusters, right? 24% is expectations. The 10-year average, for those people who like math, I know Bob does. Jimmy, you have a hard time doing math with that abacus you have there. But the 10-year average for earnings per share year-over-year growth is 8.6%, folks. So you're seeing 3x. And the forecast for Q3 and Q4 is equal, if not more. So it feels like a water. You always use the analogy, Jimmy. You take a basketball and you put it underwater. It feels like that. We just haven't seen that pop yet because we're still trying to gauge. And this is a big week for earnings, setting the tone.
So one thing I would say too is that, and I agree, the earnings thing is amazing, particularly in technology. But I will say this is that I don't think they're going to tighten either. The fact that we're at 30% now, 1 week away, is troubling. I don't think that's happened before. Now, the one point I really want to make, and that I've been saying this the whole time on the Futures Edge and Unfiltered Investor, my belief is that there is a level of 10-year. I think it's about 4.9-ish, where all of a sudden the whispers about intervention, actual intervention, the Fed coming back in and buying the bonds. At that point in time, that could hurt the dollar. That's when I think the gold and silver trades pick back up. Bobby, what do you think in that first? And then your question.
Well, gold, let me talk about it technically real quick if I could. Gold is actually quite a ways from, I mean, the way that we term it in the newsletter and the way that Mike Arnold and I talk about it is quite a ways away from being in a bullish setup. It seems more like a corrective phase up for a slightly mild bear market. I don't want to call it a bear market. That's the wrong way to look at it. But for a slightly small downtrend that it's been in, you got to get about $300 higher than this, somewhere around 4,400 or so to break out. Bitcoin, on the other hand, it's not what you asked about, but Bitcoin, on the other hand, has actually broken above its 50-day moving average for the first time, I believe, since about March. Don't quote me on that month. When you put those two things together, you are looking at a little bit of a situation where maybe some of the speculations come out of gold and maybe some of the flight to safety is starting to creep back in. But when you have, like Jeff mentioned, highest close for the 10-year, the 10-year closed at 467 today. It closed at 467 on May 18th or 19th. I don't remember which one. And that is the high, those 2 dates. So Jeff is right. It's the high for the year. It's tied for the high for the year. So I think there is room for precious metals to go higher. But I don't think it's going to go higher as long as you have this underlying feeling that the bull market, the resumption of the bull market's right around the corner equity-wise.
Jeff?
I think it's interesting with the 10-year here. I think something's going to give, right? And we've kind of seen this a couple different times, a couple of pump fakes, but you're right. The 10-year has been stubbornly above 4.5%. And some people say it's because of growth. That's the optimism. That's the rosy lens to look through. Other people are talking about the lack of appetite for treasuries. But I think Kevin Warsh, who I think is going to be going down in history, is probably one of the best and smartest. He's not a PhD. That guy traded. He knows what he's doing. He has the ability with all the tools in his toolbox. Maybe they do some form of operation twist, because right now with the long end of the curve, the front of the curve moved up higher, to your point earlier, Jim, when you're leading in about the 2-year. But the long end of the curve rising, mortgage rates higher, they're really going to try to move rates lower. So maybe they come up with something. But right now, it's fascinating to me. And I tie it all back into kind of the Essential 40 here, which is on the sleeve right here. I have to get you guys one of these shirts here. Iuorio may be a little too fancy for you, Iuorio, but I tie it back in that you may see these higher rates hurt some of these Mag 7 names. Again, because if you look at the breadth, and that's one thing I know we want to talk about today, the other 493 stocks in aggregate, they're up about 10, 11% year to date. So you are seeing this fourth year of the bull market broaden out, which I find optimistic, but there's these little acute moments in time where you're just kind of scratching your head. What are we doing?
So you mentioned,
we got Tesla on the screen. Well, it's going to be on the screen in a second. Tesla misses 33 cents versus 51 cents. That's just the basic number of it. Jeff already talked about Tesla being lower. Go ahead, guys.
No, so I care more about Google because as you know, Jeff, you haven't been on the show in a while. Do you know why I own lots of Google and have for years?
No.
About 7-8 years ago, I realized that Google was just an arm of the CIA. And anyone who used to argue with me about that, I'm like, are you out
That's
of
why
your
he didn't come
mind?
on the show.
Are you out of your, of course it's an arm of the CIA. You think that the intelligence community would let other people collect data and intel better than they do? It's absurd to think they're not. If someone says they're not the CIA, they're the ones that should be wearing the weird hat. Anyway,
well, I shouldn't be smiling because I'm long Google myself. It's an Essential 40 holding too.
I'm long
down
a lot
$4.50, but I look at let's switch gears. Let's go to Tesla here, which I didn't know people are still looking at Tesla as a car company, despite
Bob, you know, he just acts like he runs the show now because he doesn't want to talk about Google being the CIA. Let's switch gears here. Let me ask you a question. Go, Kilberg, your show.
Nothing's changed. We used to be on a lot together. I don't think anything's changed. We took a little 3-year pause, but no, I am fascinated to see. Look, Google, I haven't had an opportunity to dive into the numbers, but they are a diversified company. Whatever you think their focus is your opinion, but I think they're very diversified. I want to own Google here. I like that it was closer to $400 and versus it is at $343. But it's an interesting week, Jimmy, because I haven't seen IBM come out yet. Have you? I guess IBM doesn't come out a little bit. It's up a couple bucks. Maybe you can pull that ticker up. But this whole tech conversation in this rotation, I think that's been so pertinent, and not just in 2026, but the last quarter or two of 2025. And that's where, again, I'm bringing it back to the Essential 40, but that's where we've seen outperformance, total return, is because we're owning some of these stocks that no one wanted to own for years. The Mag 7 lifted everything the last couple of years.
Jeff, I'm going to put a chart up that I guarantee you haven't seen, because I showed it to Charles Payne. I showed it to a bunch of other people, and really no one has seen this except my business partner and mine and Jimmy's partner in our newsletter, Mike Arnold. This is the XLV against the SPY. Okay. This is a monthly chart. So essentially what this is a mix of tech and other things, right? Against healthcare, which is one of the better defensives, right?
Yep.
So healthcare representing defensives. This is where we are now in this particular relationship. Now, the right axis is performance of the two, right? So tech outperforms, tech outperforms, tech outperforms. That's what we're all used to seeing. But this has been healthcare outperforming, and we hit a level we haven't seen since the dot-com bubble, and we hit a level lower than the great financial crisis. Now, I know I'm just kind of springing this on you and you haven't seen it, but would you ever look at something like this as an indicator of anything, or just as something that's fucking interesting?
No, it's fascinating to see that, and I like how you broke this apart. It's a great chart. What I found interesting in 2026, and I know Jimmy was trading back when the dinosaurs were running around, but I don't know any other year, Bobby, there's been this type of historic dispersion. If you go back into Q1, you saw energy up 40%, you saw financials down about 8%. That's a 50% dispersion. So I think you bring up a great point. And even if you look at, I don't know if you guys look at the CBOE's dispersion index, that DSPX, which talks about the single stock dispersion versus the sector dispersion. But if we finalize the thought on the sector dispersion, I think it's creating opportunity. So we own Lilly, we own Johnson & Johnson, we own Pfizer, we own some of these healthcare names, which absolutely got thrown away with the bathwater last year. So I think this is a great point. And, you know, you brought up Bitcoin earlier. Bitcoin just outperformed SOXX for the first time in the last week or two. So there is some stuff going on underneath the surface, which, again, I'm looking through a bullish lens, but I think there's reason to, and that's because of back to earnings. So I think that's a great chart you bring up. I love the fact that it's been dispersion in the S&P 500 sectors, because what does that mean? That means it's time for a stock picker. You have to be able to pick stocks. You can't just hop in an index and hide.
That's essentially what your firm does with your products, right?
That's right. And we actually have a second ETF we launched last December. It's called the Mango Growth ETF, ticker symbol Gary. Gary, just like the name, and that's growth at a reasonable yield. But that is a very hot, high beta ETF, both traded at the NASDAQ. And we actually, Morningstar, I didn't even know, but as a close for the second quarter, we were the number 3 growth ETF in all of America. So we had great performance. We were up about 31% in that quarter, about 37% year to date as of 6/30/2026, my compliance officer would want me to say. But we have kind of the core holding, the Essential 40, and then we have a satellite in our Mango Growth ETF. So that's where I think there's opportunity. We've owned more semiconductors. We stayed away from software. So we were dancing between the raindrops, and a very tactical. We trade a lot in that ETF.
So, Luis, can you put up the 2 earnings that Remo put here? By the way, Remo said hello, Jeff. I don't know if you saw that.
Yeah, I didn't say, hey, Remo.
IBM 293 versus 297 expected, and then Snowflake 90 versus 85. I don't care about Snowflake. Maybe you guys do.
No, but I want to throw a wet blanket on you guys. Jeff's been talking very enthusiastically about the rotation. I want to put some numbers behind that, and then we can decide if it's what stage of the rotation we're in. In May, the top 7 stocks were 35% of the market cap of the S&P, not the NASDAQ, the S&P. The other 2 times that it's been the most concentrated in the 7 stocks, it's only been 26%, in 1980 with energy stocks, and then in 2001 with tech stocks. This was historically narrow. The seven stocks. Now it's only dialed back to 3.2 and then bounced back to 3.3 over the last couple of days. So you will agree that this rotation, that it's begun and that the market has taken the punch fine, is a good sign. But there could be a lot more to go. And rotations, if they get disruptive, can be inelegant, you'd say, right, Jeff?
Well, I think my thought on that, Jimmy, it's a different economy than those previous timelines you talked about, right?
Oh, yeah.
It's a very different economy, very tech focused. But I think this great rotation, first and foremost, became great profit taking. I mean, you think about some of these names, and if you own any memory in SanDisk or if you own Micron, good God, you never go broke taking profits. And I think when you see
40% off of Micron and 100% off of AMD. Yeah.
Right. And then we actually own Micron in the Gary ETF. And then we closed it and we sold it from 600 to 700. We look like morons, right? Because it went up to 1200, but we owned it all 2025, all 2026. So I guess my point of saying that is that all these levered ETFs, all those zero dated options, everything that's kind of tied to profit taking, once someone kind of goes for the door, that little door, everyone kind of runs. And I think that's big, more of an undercurrent versus, walking away from what's kind of leading our economy, which is technology.
I'd tell my own Jeff Kilberg story if I could.
Please.
So Jeff and I sort of knew each other on and off, but the first time we ever did a CME video together, I come up to the studio. I was replacing Jimmy, actually. Jimmy was out.
Easy to do.
Yeah, Jeff was very kind to me. We had never actually had conversation before. We were kind of joking around back and forth. And then Jeff felt comfortable enough to go, yeah, it's another Italian. We got to get the box here. You guys don't know, Jeff's like 6'12" or something. I don't know. He's not a short guy. And I am a half inch taller than Jimmy. That's what I always like to say. So, Jeff is breaking my balls a little bit. These Italian guys don't reach anything. There were two other people in the room, actually three, a German guy named Brian, an Irish guy named Ryan, and a woman who's always up there. I'm going to leave her name out of it because she's got a unique first name. And they're all laughing. They're like, yeah, the Italian guy this, the Italian guy that. We finished the video. Jeff walks out, and I turned to the woman who's part of the crew there. And I said, if I would have been African-American, would it have been okay to talk like this? Dead serious face. And she goes, oh, my God, I am so sorry. I'm like, I'm fucking with you. I don't give a shit. I could care less. That's how we are. We all ripped each other on the floor all the time. It's just par for the course.
That's too funny.
Really a Kilberg story, but he got it rolling.
The fact that Italian men are short, is that part of the anger issues that really were the roots of organized crime and mob murders? Is that part of it or no?
Unequivocally. You got to realize, I grew up in the northwest suburb of Chicago, Park Ridge. In Park Ridge, you're either Italian or you were Irish. And that's where all the tradesmen, my old man was a local 134 electrician. So I grew up with a lot of Italians. So I guess that's where it's easy to bust chops.
Well, it's funny is that because I do think growing up in Palatine, which was kind of a heavy mob area, and I never dissuaded people from thinking I was part of the mob. Why would you? You know what I mean? If people are going to give you a wide berth, you accept that wide berth, right? So
absolutely.
I always said I had an Uncle Vito who he just kind of takes care of things. And I never said any more than that. And I said, if you want, I can get Uncle Vito involved. Like, what does he do? He just kind of fixes things.
Well played. Well played. I love my Italian.
Jeff, that I always ask people who do the kinds of things that you do. And what I mean by that is you're not a day-to-day trader anymore, right? Your products are at least medium term. They're long term in my view of the way I do things.
Yes.
How do you convince people that it's gonna be okay? What's your angle that you take? We have a lot of financial advisors on here and things like that. Actually, probably 80% of our guests are financial advisors or economists of some sort. So how do you convince people? No, everything's going to be okay. Just take it easy. It's designed to withstand this. Go.
Well, I think I have probably the most different background than most ETF portfolio managers out there. And that comes from my career, which started the Chicago Board of Options Exchange. And I ran the Chicago Board of Trade for a long time in the U.S. Treasury pits and the 10 years of market maker. And then I took my operation upstairs, which I wasn't smart enough, but I bought a seat in the late 90s. That seat materialized into a nice little war chest. So I kind of we were trading everything when we were upstairs, Euro currencies, crude oil, you name it. But that background, that risk management kind of helped me form. And in 2012, I created KKM Financial, Kilberg Capital Management, misspelled Jimmy by design, had to use my marketing degree from Notre Dame. But the reason that we kind of created this firm to be a boutique asset management firm, and we were lucky enough, we've been a portfolio consultant to Nuveen Investments. We have 2 ETFs in the marketplace. We just knocked over $1 billion in AUM. So it has been a slow and steady growth. But the reason why, one, I wanted to be able to serve advisors and ultimately their clients as well as my own capital in that longer term perspective. So when I look at what we're building, we're trying to, in the Essential 40 example, we are trying to create more thoughtful sector exposure. Are we going to get it right all the time? Absolutely not. But by having consideration, by being different and by having a different lens to look through, that does help us dance between some raindrops. The Mango Growth ETF, it's a high beta growth portfolio, but we have conviction on this, right, wrong, or indifferent. I always put my money where my mouth is, right? So I'm invested in all my own products. But that's, I think, the differentiator. And when I look at the bigger, broader marketplace, we have a product, the Essential 40, which has a ballast built into it, a defensive mechanism and the equal weighting, and also by owning the blue chips. But we also are considerate in our Mango Growth ETF, we can go to 20-30% cash when we want, and we have this year. So very tactical on that. So I kind of taken some of my attributes, some of my skill set from yesteryear, and kind of brought into more slower portfolio management, which I think does resonate and knock on wood, help us moving forward. But of course, my compliance officer will always say past performance.
There's two things. One, we got to take a quick time on the show. But Bobby, did he say it?
He did.
I did.
At 22 minutes, he said it. 22 minutes, he said he went to Notre Dame, which, by the way, it had been under 20 minutes. Bobby owed me 100. It's over 20 minutes. I owe Bobby.
Kelsey had it at 5 minutes.
It was at 22 minutes when it happened. Hold it. Take a quick time out. Luis, will you put the banner up? This is the part of the show where I ask you guys are watching to do us a favor, and I so appreciate that you guys always come through. Please scan that QR code and try Tradier Pro for 3 months for free. We talk to people who've traded options for decades and some who've traded them for days, and they all say the same thing about Tradier Pro. It is absolutely the gold standard in options trading platform. Do it because you're interested in it, or do it as a favor to us. But either way, please scan that code and try it for free for 3 months. And now back to the show.
I want to put this Mango Growth ETF up here on the screen before, real quick. By the way, that's the first thing Jeff Kilberg said to me. I told that story the first time I met him. He's like, Bobby, it's nice to meet you. This is going to be a really easy show, like Coach Holtz told me. Boom, like it was in his first sentence. But I did say, condolences.
You know what Jimmy's favorite joke is, Bobby?
What's that?
Walking into a room of 100 people, and only one person in that whole room went to Notre Dame. How are you going to find out?
Yeah, I know.
Don't worry.
He'll
He's going to walk
tell
up and tell you.
We talked to a guy named Mike Singleton, who you should meet, also a Notre Dame guy. Never brought it up. We told him we were really disappointed when we found out.
Yeah.
My son-in-law only brings it up during football season, and then he's crazy. But that's the only time he brings it up. And I love my son-in-law, so I actually like Notre Dame now because of my son-in-law, not because of you, Kilbert.
And there's no way the son-in-law likes you. That's not reciprocated. That.
I think he does, or else he
not
fakes
a chance.
it pretty good.
I do want to ask you when we get done with the show who you think is going to win the Bears left tackle competition, because you were an offensive lineman at Notre Dame. But this is the Mango. What's that?
Yeah, I played for Joe Moore, which is the Joe Moore Award now. It's kind of like the modern day Heisman. But if you know the Joe Moore Award, it awards the whole unit, the whole offensive line, which is kind of cool versus just the
That's
Heisman
very cool.
Lombardi.
That's more the characteristic of an O-line.
That's right. That's right.
All right, so this is the Mango ETF. How much of this performance is a straight performance? Is there any, hey, we just launched, there's a lot of activity driving what we're seeing on the screen here? Because honestly, this looks great. You couldn't really tell it apart from the S&P except in the downdrafts, which again, you guys do really well managing that.
Well, I think so. As of 6/30/2026, the large cap growth ETF category at Morningstar was up about 7%. We were up 37%. And again, I wasn't a math major at Notre Dame, Jimmy, but we had that ability to create that alpha. Why? And a lot of the attributions in this ETF, which I'm pulling up on my Y charts right now, we own Applied Materials, we own AMD, ASML, Palo Alto Networks. We own some of these names. We owned Micron for a long time. So we were picking stocks appropriately, but we kind of stayed away from some of the software names, which, the Oracles, which were great last year. The number one stock that we've owned in the Essential 40, which we also own in Gary, is Intel. So we continue to try and be selective on our stocks, right, wrong, or indifferent. That's been the difference. And we have been very tactical, gone to cash a couple of times in 20-30% of the portfolio to try and ride out those. You're seeing these volatile moments, and there's just such follow through. And I think it was when he had margin calls, over in Asia. 1 out of 30 accounts in South Korea had a margin call, right? So we're trying to weather that. It's like, I hate using the analogy of gambling, but it's like being in Vegas and you're going through a bad shoe at the blackjack table. It's like, how many more punches are we going to take here before it reverts? And maybe that healthcare chart, maybe Bitcoin moving, maybe some of this earnings season will be this ability to kind of pop back up and resume this rally.
Got it. Bobby, you go.
Is there any way that I agree with you, the Fed's not going to, let me rephrase this. When I was on Charles Payne's show, was it like 8 days ago or so, he said to me, do you think the Fed is going to or should hike? And I said, those are two different questions, right? Yeah. No, I don't think they should. And the answer to the second one is no, I don't think they will, For the same reason that you said, Jeff, I think this guy is wicked smart. Like, I think he's insanely smart. I think he comes from the right background. And I think he knows that this is not the right time to do it. The Fed can't do anything about an energy supply shock. But the only thing you could do, because we're getting the problem with the crack spread, and guys, tell me if I get too much in the weeds for the audience. Problem with the crack spread now is even when crude declines, gas does not, because we don't have enough refining capacity to store gasoline, to accumulate gasoline or distillates of any sort. And even like the first refinery since 1976, I think it's in Brownville, Texas, it just finally got permitted in 2026. They announced it in Trump's first term. And they've just broken ground in the second quarter of this year, and it's not up yet. And it's only supposed to do about 60 million barrels of product. So you can't get that crack spread to tighten up and bring the gasoline prices down with it. Could that be a reason, in your view, that the Fed could come up with it and say, you know what, we kind of have to cause a recession? They never say that, but we all know that's what they're trying to do, right?
Yeah, I think to get the genie back in the bottle, right? I mean, we saw inflation at what, 9.1% a couple of years ago. And in order to get that back to their target, which is kind of laughable, their target of 2%, we'd have to go to zero or even deflationary time, to your point. So I think it's interesting. The input that's really kind of swayed the data the last month or two has obviously been oil. And I've been talking about kind of $80 that WTI crude oil. That's been kind of the all clear. And we almost had an all clear. Right. And all of a sudden we've had 11 nights in a row of strikes. So all of a sudden it went from, $65, $66 a barrel back up to $86 a barrel. So I think the emotion in the trade, Bobby, is convoluting the actuality of the inflationary input, if that makes sense.
No, that actually does make sense. Here's my thesis, and I wanted to discuss it too, is that I believe this, is that the Fed is looking at a one factor inflationary problem. Obviously it's a supply shock. That supply shock and gas prices, each person in this country uses 400 gallons of gasoline per year. Family of four, that's $1,600.
I have a Tesla. I don't.
You have a Tesla, but for I just per capita, I'm saying. So anyway, so what happens is that when gas prices go higher, of course, it shows up immediately in inflation. I know, Bobby, it's a little bit of removal, what I used to say, because now I'm giving it 8 months where it's a direct correlation. Higher energy prices equal higher inflation. Then at the end of those 8 months, the fact that it's been dragging money out of people's pockets for so long starts to be a deleterious effect on the economy. If the Fed raised rates 4 months into it, those aren't going to be felt until 6 to 8 months down the road. So anyway, there's that convergence of the Fed trying to cause a recession and the oil itself trying to cause a recession. And history is pretty clear on this. Recessions come after these supply shocks. Am I missing anything there? The Fed should just do nothing, right?
I think the Fed does nothing. And the one thing that maybe you're missing, but I know, it's the balance sheet. That balance sheet, if we remember going back, when Jimmy had his 75th birthday back before the great financial crisis,
I remember.
The balance sheet was $450 billion with a B. All of a sudden, after the GFC, it went up to $4.5 trillion with a T, and then it popped up to almost $10 trillion. And now the balance sheet kind of ran off a little bit, but it's not running off anymore. They're expanding it still. So here we are at $7 trillion. That, in my opinion, guys, is the ultimate shock absorber. And that's why I don't see a recession anywhere near on the horizon. And that coupled with earnings and profits of corporations, like I know I'm probably a little bit more bullish than most guests right now, but there's just a lot of noise in the marketplace now. We got midterms on top of it. I don't get political, but that is an input. And all this is kind of coming into fruition. But I think with the VIX at 16 and the dispersion SPX VIX, which is kind of a cool metric. I don't know if you guys have dug into it, but that D SPX, it's at the highest it's been in years. It's up at 47, meaning the dispersion between individual stocks in the SP 500 has never been higher, kind of like the sector dispersion you talked about earlier, Bob. So all that together, I think the perfect storm, the risk to the investors out there is being underinvested, is being short. Doesn't feel like it today. Hasn't felt like the last 11 nights we've been striking Iran again. But I think the risk to the market is being underinvested because I think we can pop and touch 8,000 the S&P 500, 2 shakes of a lamb's tail.
I actually don't disagree. And you mentioned one of the bullish theses. You said the Fed is expanding its balance sheet. I know that's not a great bullish thesis.
You'd rather be quiet. No one's supposed to know that.
But it's been like 300 to 400 billion that they've expanded in the last 8 months. Remember when they started doing it? It was just
to provide assets, but it's not QE.
Yeah. Right. It's not QE. Also, deficit spending is enormous, and M2 money supply is increasing at somewhat of an alarming rate. So M2 money supply increasing, the Fed's increasing the balance sheet, which is part of that. I know they're blending together. That is another bullish thesis, to be owning stuff and not being owning the dollar. So I agree with you. Do you think that is your thesis on the stocks? I know you're a bull on the stocks. Are you a bull on the economy as well? And if so, why?
I think the economy's been pretty bifurcated, right? And I think the higher end of the marketplace, people who own stocks, have been doing well. But I think the lower end of our economy, the middle class, the lower class, they're hurting right now. Everything's more expensive. I mean, for Christ's sake, Jimmy, you're charging $50 for your burger probably at Brandt's now because you have to keep up with inflation. So I think the market, the economy, despite the fact that the corporate profits are at all-time highs and you're seeing more and more 52-week highs as this economy broadens out from a stock perspective, I still think there's a lot of fragmentation and bifurcation in the actual real economy. And that's a problem. And that's why these interest rates at 4.66 in the 10-year, that's a problem. They have to come down because we have to have relief. We're seeing the 30-year mortgage. I mean, raise your hand if you don't want to refinance your mortgage, right? I mean, everyone wants to refinance their mortgage. There's been no opportunity for years. So they're all connected, and there is pain at the pump. There is pain in mortgages. New home buyers are kind of, you're seeing homes for the first time kind of dip here. So it's all connected, but I'm thinking and I'm believing in the back half of the second year, rates are going to come down. We just haven't had enough data to support it. And all of a sudden you see crude oil back at $86 and people freak out.
And Bobby, I want you to ask this question, but I'm going to put it to you too, because and I don't like to talk about politics either, but I sure as hell will talk about policy. And one of the things you're talking about, 60% of the people not participating in this, is one of the reasons we're getting guys like Mamdani, the lady in Seattle, these Democratic socialists, because there's a lot of people who have this burn it all down mode. How do we fix that, Bobby, or do we not?
Well, it certainly doesn't help having 6,600 non-citizens on the voter rolls, but that's my foray into politics. That's it. The way you fix it, honestly, is the war has to end, regardless of how it ends. It has to end. But even that, at this stage, on the energy side, it's a little far gone because of what I talked about with the crack spread. You can't simply reopen things. Wells that were finally reopening, some of the larger ones in Saudi Arabia, for example, and UAE are still shuttered. And the reason is because you get that wax that develops and the well has to actually be re-drilled. And now that the aggression has started again, they're not going to re-drill those wells. And they seize up even more. And they're going to have to re-drill them from a different angle. And some of those become weaker because of the angle. It's a weird thing. So you're going to have less oil production even when it all blows back open.
Are you buying oil?
Am I? Yes, I have been.
Okay. You should have told me that.
Real quick, I want to put Widge up, Jimmy, if I could.
Sure.
Widge says, my electricity generation prices have almost tripled in the past 6 years. Meanwhile, big tech price is insensitive and blowing out CapEx demand. I think the Fed better act soon or regret it. Can we put up the second part of that, Louise? If the Fed wanted the 10-year to drop, they'd be hiking rates aggressively. Either you guys got that?
No, Widge always throws a curveball to me, and I always like the things that he says. He's a very, very smart guy. I think that if they hiked, I do think the 10-year would crater if they hiked, because they'd be forcing us into somewhat of a recession, right, Jeffrey?
Go ahead, Jeff.
I have to hang my hat on the fact that, look, I traded bonds for a long time, and I trade a lot of equities now, right? And we still trade a ton of equity options, and I think the bond market is telling us something. It's flashing a light at 466, 467. But I do not believe in my gut that Kevin Warsh is going to do anything. Not fear from the administration. It's just the fact that he's going to sit on his hands, assess things. He's building his little committees and arsenal, and he's smart enough to figure out another way to get that long end of the curve lower if need be. But I think he really wants to see the war end. But the one thing you talked about, Jimmy, just to put a finer point on it, is how do you get more people involved? And it's Trump accounts. Trump accounts are getting its ownership. It's owning the stock market. So I've heard.
I want to hate him, but I love him. Yeah.
Well, you're too old. But they're talking. They're talking about. Yes. My daughter. I just got her a Trump account, and I know a lot of people have a problem with the name of the account if you don't like the administration. But at the end of the day, that stock ownership, I think that makes a difference. And I got my kids all started owning stocks at a very young age, and they're into it, right?
And you understand why I'm against it, right? From my libertarian streak, I don't want the government involved in shit, but I do think the outcome is going to be overwhelmingly good and positive.
Well, I'll give you one good example. I agree with you. I don't think the government should be involved, but the one thing I was happy they got involved was Intel. So we own that in the Essential 40, and we reloaded at $19-20.
Is that why you bought it? I meant to ask that actually. Is that why you bought it?
Well, our thesis has nothing to do with the administration. Our thesis in the whole portfolio is what is most important in the U.S. economy. So while we caught a lot of heat for owning Intel, it was still a U.S. domiciled chip maker. So that's what we owned it. So the lens we look through, it's not relative strength, it's not price performance. Like United Healthcare. People were giving me shit last year for not selling United Healthcare, was trading 240. United Healthcare still had 80 million Americans. As long as nothing nefarious was going on, they weren't cooking the books like Enron, we still owned it, and we bought more in January. Why? Because 80 million Americans are subscribing to this superior pay collect mechanism for doctors and hospitals. Unless someone comes up with a better mousetrap or a superior pay collect mechanism, we want to own United Healthcare. Last quarter, United Healthcare recovered to $430. So that's the lens we look through, if that helps you. And it's kind of indifferent who's in the administration, right or left.
So real quick, Widge said, hate the Trump accounts. For the love of God, people are fighting socialism or pushing it.
No,
I want to say something.
I said I would vote against them, but I think they're going to be a great outcome. Yeah.
I don't like that the government did this, but if you look at what the Trump accounts are, they're untaxed money being put into a broad equity index. Untaxed is the opposite of socialism. Now, I understand that the government's the one who did it. Okay, but the more tax-free dollars you can get into assets, which, by the way, we all forget, stocks are it's bullish for inflation if to own stocks. With inflation comes asset inflation, and stocks are assets. So actually created by the government, yes, but the structure of the Trump accounts are anti-socialist because there's no tax.
Yeah, and the tippy toe through here for the Widge. I love the Widge. That's a great name. But my thought is, or my answer to Jimmy was, it wasn't about Trump accounts. It was about ownership via Trump accounts. But any way you can find ownership, socialist or not socialist, it's ownership in the stock market. That's how, in my opinion, the next generation or two resolve this issue of this bifurcated economy. So that was a non-political answer.
I want to reiterate again, Widge, that I would be voting against it if I was a congressman, knowing full well that I think the outcome is going to be excellent. Just I don't like opening the door to the
kissing up the Widge.
Well, Widge just said government funded to come back to me, right? But my thing is government doesn't fund anything. We fund the things. So I'd rather the money came back to young kids and get them involved and get them in a position where they're not worried about Social Security. It's not like we're paying money to the government and they're putting up statues, right? They're giving it to the kids, which, yes, the structure of it is socialist, but they're giving kids basically their parents' money back.
Yeah. And I was asked by Kelly Evans. I was asked by Kelly Evans on air, what would you buy in these Trump accounts? And of course I said ESN is a great ticker, and so is GARY. But nonetheless, and I'm busting chops now, but it's stock ownership. The more people that participate, the more people that can save, the better off the U.S. economy is going to be. It's not going to be an overnight fix, but it is a generational fix.
No, but Widge is our buddy. We go back and forth with him a lot. We agree on about 60%.
Usually right.
And argue about 40% of the others. He's fine with it. We're fine with it. So
yeah, he honestly is usually right. I usually don't disagree with him. But real quick, Dougie said, I think the Trump accounts is a good idea to encourage savings and market participation. The name only is a major roadblock for many people. Then those people are stupid. You could like scratch it off with a pen when you get done. I told my niece just had a baby, and I called her up and I said, "Oh, get that thing today, okay? Because they'll take it away." At some point, they'll try and take it away from you. Second thing, Remo says Trump account, get the public into the game, which to your point, Jeff, I mean,
ownership.
Now that you can get fractional stock ownership, there's very few people that shouldn't be invested. Invest with $10. Like, I don't care, but get into the market, start understanding how it preps you on a buy and hold situation.
Bobby, before we go, and the last thing, can we do a technical breakdown of Essential 40?
Yeah.
Yeah. Because again, Jeffrey, we look at things in somewhat different time frames than you do. I actually think it's excellent. I'm looking where I'm going to get in, and I will always use technicals to figure out where I'm getting in.
For sure.
Yeah. Hang on, let me get it. Jeff, what is it? ESN?
ESN. And when you're pulling it up, just to kind of speak to, obviously, you go to the website, the Essential 40 ETF.com, all the holdings are there. But Intel, Palo, but also Marathon, CVS, Apple, United Healthcare, Delta, EPD.
Always be selling.
ExxonMobil.
Coffees for closers. Keep selling.
Well, Johnson & Johnson. But my point is it's diversification. And if you don't like ESN for diversification, as long as you have diversification inside the sector dispersion, it's important. So,
and I love the equal weighted notion of it. I actually think this is a pretty genius thing because everybody's trying to do some complicated option layover ETFs. This one is just to the point, and the equal weighting of it, I think, is brilliant and beautiful.
And I think the rebalance, a lot of people try to overdo it. And if you rebalance on a quarterly perspective, you're overbuying your losers and you're amplifying that downside. So that's another kind of component when people rebalance too much.
Okay. Luis, I'm sorry about yelling. I typed into the chat there that he should put the chart up. So I'll tell you right now, just from a signal perspective, okay, I had a buy of the Essential 40 Tuesday. I had a buy signal on that.
Going below the rotation zone and then above it.
Yeah, and and then I had the percentage B buy.
We did have a $10 million inflow that day. Was that you, Bobby?
No. I don't ever have someone on the show without buying a little of it. So
no, I love it. No, we actually just went over 300 million in AUM at the close of the quarter. So the story is getting out there. I don't have a 400-person Invesco wholesaling team, me, myself, and I, but we take a lot of pride in to manage it as being one of the portfolio managers.
No, but look, if I put a horizontal line here, you got a breakout level on this chart. The breakout level's right about here. Okay. And it's really simple. It's a horizontal channel with a fake breakout here, the second breakout. If it comes back down to about 1993 after closing above it, it's probably hitting about $25. That's the technique.
Your lips to God's ears.
Yeah.
Yeah. I'm going to take some, if it takes out that wick, Bobby, that's the spot I get in, put my stop there.
Yeah. Put your buy-in stop and then put your stop below that low. You see what I'm talking about.
Put some of that communion money in, Jimmy. I know you got that communion money still saved.
Oh, no doubt about it. Yeah. I'm going to put the money I won when Secretariat won the Belmont.
That's the best story. That's the best.
All right,
you guys he does have the best ribs and burgers. If you're ever in the Chicago area, go to Brandt's.
The
ribs and burgers are absurd.
Are you in Chicago? I'm going to the ballpark tonight. You're not going, are you?
No, I'm not in Chicago. I'm going somewhere fancy where you're gonna make fun of me for saying Nantucket, but no, I'm not in Chicago.
You're going to Nantucket? You absolute loser.
Hey, real quick, I got a question about the Essential 40s. Luis, can you put that up? Are the telecoms, Verizon, AT&T part of the Essential 40?
Verizon is in there. AT&T has not been. Every year we have a turnover about 5 to 10%. So you'll see 1 to 4 names kind of roll in, roll out. But Verizon has been a great name for us. It's been outperforming. I think AT&T is down 10%, even though they're up 5 or 6% today. And year to date, Verizon has just been outperforming. So that's the ownership.
What about any materials exposure? Like, is there Freeport-McMoRan? Or
Freeport-McMoRan came into the portfolio 2 years ago. We also own Newmont came in, so we have material exposure there. It's been a really interesting portfolio where EPD got added in. Nutrien is in there, but we also have kind of some of the boring names, like Costco. Some of these names you just don't hear about on TV.
I love making money the boring way.
ADP, Home Depot. Like, we never wanted to own directly to the home builders, but we own Home Depot, Masco, 3M. So that's kind of the exposure where, again, we're just trying to be more considerate, thoughtful our exposure. And our 40 stocks, believe it or not, Jimmy, we have a lower beta than the S&P 500 equal weight index with 500 stocks in it and a better Sharpe ratio.
So I am buying it over that wick tomorrow, and then you have options, right? I mean, there's options in it.
There are not a lot of options trading on it. I mean, there's options on every ETF, but I would not trade options in this. There's other liquid instruments that you would probably want to trade on RSP, to be completely candid.
No, I like it. Yeah. All right, Bobby, got any other words?
No, I just want to put up Remo's comments and thank Jeff for coming up here.
I can't believe it took you guys 3 years to invite me, but thank you for
it's not even
on.
It's just
It was
Don't
great.
make me read it.
Hopefully we get an opportunity to get together soon, boys.
By the way, off air, we should read your response to the email, Jeff, because it's very, very funny.
I love off-air comments. You know that.
It can't be read on air, right?
Never.
Hey, real quick, one more question before we let Jeff go. Do you have a screener criterion that keeps the Essential 40 fresh? Are there any metrics that are standard?
So we do have a quantitative input. Initially, we'll take personal consumption GDP, take that data and help us understand which sector should be outperforming in the next 12 to 18 months. But everything else is qualitative in nature. And market cap, I would say, without kind of giving too much look inside the black box, market cap is a very important input. why do we own Exxon versus Chevron? Exxon has larger market cap.
That makes sense.
Handle's going to be your next 10 million that you see going in the next couple
Bring it,
days.
Handle.
I'm just going to put a couple million in tomorrow when it goes above that level.
Well, I don't know if I have extra small shirts, Jimmy, but we'll get one sent to you.
That's just rude. That's just so rude. Anyway, he's Jeff Kilberg. Don't follow him on Twitter.
Love you guys.
I'm Jim Iuorio. That's Bob Iaccino. Thank you guys so much for joining us. We really appreciate it. Also, join Bobby and I. We are 2/3 of the team at unfilteredinvestor.com. You will be happy with it. It's gone very, very well. Bobby and Michael's technicals are amazing. That's Jeff Kilberg. This has been the Trader's Edge. Thank you guys.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.